On this episode of Through the Pines, we'll cover the most important concepts investors live by. Welcome to a financial planning podcast with a down-to-earth vibe. Sasquatch listens while performing his optimized morning routine. This is Through the Pines. Our advisors for this episode, we welcome back Rex Baxter and Brandyn Smith from planwithbaxter.com. They are the 2023, 4, 5, and 6 Forbes Best in State Wealth Management Teams for Utah. Congratulations, Rex and Brandyn. Fantastic work. They're also the Advisor Hub's fastest growing advisors to watch under $1 billion and the receivers of the Ameriprise Client Experience Award. So they know exactly what they're talking about. And this is the concepts that they talk about the most, essentially, on this particular podcast. So we'll get into setting the stage, what is the stage of the overall concepts in financial advising, and then how our portfolio is built to support your goals and what it is that you want to do. So Rex and Brandyn, thanks for coming on the program, and let's dive right in to figuring out what are the most important concepts investors live by, beginning with setting the stage. Brandyn.
Yeah, so really what we want to do is talk high level on this one about what should be conceptually in the back of your head as an investor to make sure you stay on the rails, right? So to make sure that you don't get too emotional with investing, that you stay within the parameters. And really what I've found is it comes down to making sure that you have a plan in place, recognizing that we don't ever know when the next downturn is going to be, and that you can have a significant downturn come out of nowhere. And when that happens, you need to have a plan B. You need to have a plan to get through that time confidently, so that you're not second guessing, you're not panicking and making bad decisions financially.
Okay, very good. Rex, where do we begin with this?
That was really well said.
Yeah.
That was really good. I think as far as high level, if we're starting, I think just talking about the different asset classes, talking about high level investing, and how each asset class acts and reacts, and how it's best utilized inside of a portfolio. Mm-hmm. I think that's probably our best starting point.
Okay.
And when we say high level, we mean ultra high level, right? And so we're not gonna. We've got other podcasts where we go into the weeds on like different asset classes and things like that. This, though, we wanted to stick with just the high level, like stocks versus bonds versus cash. Obviously, within each of these, right, there's that very big difference between high yield bonds and treasury bonds. There's a big difference between growth stocks and value stocks and small size companies, large size companies. But for today, we want to talk about stock in general and stock exposure.
Yeah, what is it and why should we own a stock, I guess? Which is, what makes me happy is when my kid, who is 11, came home from school and knew what a stock was. And knew
that's a win.
It is a win. It's huge. And knew that he was like, did you know that you can buy into a company?
That's awesome.
And I'm like, I
love that.
This is fantastic news, because I did not learn that in 5th grade.
Yeah,
right.
That's awesome.
Yeah.
It's creeping into the schools finally. I know a lot of us have been big proponents of more of this into our education system, and more of this at earlier ages into our system. And so it's fun to see that finally starting to creep in at a higher level.
Mm-hmm.
But that's probably the best definition of a stock or an equity, right? Is that you own equity or you own stock in a company. You are a part owner in a company. And what does that mean? Well, when the company does well, you do well, you participate in those revenues and in that growth. And when the company does poorly, or the perception is that it might do poorly over the coming little bit, right? Lots of times the stock value, the price goes down. And stocks, historically have been some of the more volatile assets, meaning that at any point in time they can almost cut in half in value, and who knows in the future, right? They can. The past does not predict the future, but I think it's safe to assume that stocks will continue to have a very volatile nature, meaning that they do really, really well when things are good, and then they do really, really bad when things are bad. However, historically speaking, stocks have given us some of the best rates of return over a long period of time, to the tune of about, if you look at the S&P 500 over the last 50 years, about 10% annualized, right? Which is amazing, right? Especially considering it's had some significant downturn years. To average that out and hit about 10%, that's really beneficial.
Yeah.
Yeah, I think it's really strong, right? A good long-term, strong returns in stock. I think a lot of people don't understand what a stock is or what an equity is, and a lot of times they hear, equity is, even though that's a technical term, people view that as jargon, right? Industry jargon, and really, again, it just means ownership in a company. I do want to keep this high level. I don't want to delve into a lot of non-traditional asset classes. I don't want to delve into Bitcoin or cryptocurrencies. I don't want to delve into art or collectibles. I don't want to delve
Pokemon
into
cards.
Well, we might touch on Pokemon cards.
Right? all of those things. And so I want to keep this as more traditional discussions, which would traditionally be maybe stocks, bonds, cash. Maybe touch on commodities just for a second, as far as gold and silver and things like that. But that's about it. And so I think as far as talking about stocks at a high level, you own a piece of a company, whether it's a Home Depot, a Walmart, a Microsoft, whoever the public company is. You can own stock or ownership in private companies, but we're going to focus on public companies. Those that are traded on the stock market exchanges, the New York Stock Exchange, the NASDAQ exchange, some of the the international exchanges, the Tokyo Exchange, London Exchange, Canadian Exchange, things like that.
What does Rex holding money in, putting money in stock, and so that is be part of your financial investment portfolio? What does that do for your portfolio?
It increases the volatility, and so the swings up and down of your portfolio, and it should over time increase the overall rate of return of your portfolio is what it should be doing. It should be doing
versus
those
doing
two
what else?
things versus the other alternatives, right? So if you're looking at stocks versus bonds, stocks over time should outperform bonds. If you look at stocks versus cash, right, then stocks should outperform cash over time. If you look at stocks versus commodities or gold and silver, stocks should outperform gold and silver over time. Certainly there's miniature cycles and periods and things like that where any of the others can outperform for short periods. But if you look over longer periods of times, 10-year periods, 20-year periods, your lifetime, then stocks should outperform all those other asset classes.
Okay. Love it.
But the downside is the volatility, right? It's the ups and the downs. And that's not to say stocks are the best or they're the worst, right? It just is what it is. And we have to understand the nature of owning stock in companies. Because what we don't want is we don't want you to go into retirement, have all your money in stock because you're like, man, they hit those higher rates of return. I'm going to put all my money in stock my whole life. That might sound like a great idea until you realize if you're taking distributions out and the whole market drops off 40%, now all of a sudden you're taking way too much out of your portfolios and you're not prepared for that. Not only emotionally does it make you kind of a wreck, right? Because all of a sudden your portfolio is cut down significantly, but also strategically, you can't be drawing on your portfolio that much when markets are down, especially for extended periods of time, like the tech bubble of 2000, like 2008 with the great financial crisis, right? So I mean, yeah. So anyway, so you got the stock side, then the bond side, or otherwise known as fixed income. Sometimes people call it that. And let me maybe just define what a bond is first. I like to use an example of a company, right, that's just trying to raise capital. They say, hey, we want to raise capital to build another building. Well, they a lot of times will issue a bond, right? And you see this also in communities, like municipalities will issue municipal bonds. They want to build a library or they want to build a swimming pool. And they'll go out and say, hey, we're issuing these bonds. If you'll give us $1,000, we will then pay you a set interest rate. Maybe they'll pay you 4%, right? And we'll give you $40 every year. And at the end of that set period of time, maybe 10 or 20 years, we will pay you your $1,000 back. That is a bond, right? Relatively boring. They're backed by the entity that is issuing the bond, right? So if it's a company, it's backed by the company. That company, you could buy a bond from a company, and that company could just like flounder and be the most mediocre company ever, but not go out of business and still stay solvent. You're still going to get your regular coupon. You're still going to get your $1,000 back at the end, right? As long as they stay solvent. And whereas a stock, if you bought stock in that company and it kind of floundered and you might have lost quite a bit of your money. Mm-hmm. And so bonds are a lot more stable, especially during, times of recession or uncertainty.
Okay. Rex?
Yeah, I think when you're talking about stocks and bonds, it comes down to a company's capital structure a little bit. And this gets a little bit techie, a little bit geeky, if you will, to where who gets paid back first in the order of bankruptcy or liquidation, right? And so the person that gets paid last is the stockholder, is the equity owner, the owner of the company.
Yeah.
They get paid back last. And so everybody else gets paid back first. If they've got a loan out on the building, that person probably gets paid back early.
Is a bond a loan?
And so a bond is a loan. A bond is a fancy name for a loan. You're loaning money to a company, to a government, to a bank, to somebody. And in return for that loan, they're paying you an interest rate over some period of time, 1 year, 5 years, 10 years, 7 years, whatever it is, right? 6, 7. So anyhow, any number of years. And sorry,
that was so 3 months ago, Rex.
Was that? That's not going to age well. Is that what you're saying?
No, we'll publish this quickly.
Okay.
We're already
all right, please do. So, but it's a loan that's going to get paid back, and so you're getting, on most bonds, you're getting an interest payment every 6 months. Sometimes it's every year, sometimes it's monthly, but you're getting an interest payment paid back to you, and then at the end of the maturity date, at the end of the 10 years, you're getting your principal back because now the loan is up, it's done. And so as you go through that capital structure, you're going to have secured loans that are secured by a building, secured by equipment, secured things. Those are going to get paid back first. Unsecured debt, those that are just like signature loans, are going to get paid back in that next tranche. And then you'll have your shareholders, that your equity holders, your stockholders, to get paid back last. And so when you think about risk and you think about, where do stocks or bonds come in that risk structure, that's why they have more volatility. Because if a company struggles, then people are concerned that, am I going to get my money back? Mm-hmm. And how big of a dip is that stock going to take, or is that bond going to take if that company tends to struggle?
Okay. One other function of bonds is that they can be traded on a secondary market, and it's good and it's bad, right? So maybe you've got a bond that's a 20-year bond and you decide, I don't want to hold this bond anymore. You can go out and you can sell that bond before it's due. Now, the value of that bond, you might think, I'll just take it and sell it for $1,000, right? And someone else, but you're more likely than not you're not going to sell it for $1,000. You're going to sell it for either more or less than that $1,000, depending on a couple things. And there's two main things we look for in bonds. First is credit risk, right? So if you're selling a bond and that company, started out normal and actually just got really, really strong, and now nobody thinks there's any way it's going out of business, well, then people feel a lot more confident that they get that $1,000 back, maybe 10 years down the road. Or the inverse, if a company has really started to struggle, and people might start to wonder, man, I don't know, 10 years from now, are they still going to be around? You might have to sell that bond at a discount to kind of account for people's mistrust in that company. And so credit risk is a real thing. Even though you'll still get your $1,000 back as long as the company's still solvent, we don't know if it'll be solvent, right? And so some of those dip into what are known as high yield bonds, right? Why? Because you can buy them for less, which effectively turns that yield higher. Maybe it was issued at 4%, but now it's yielding 7% because instead of buying it for, $1,000, you can buy it for $700. And that bumps that yield. Mm-hmm. And so the first risk that's going to change that price a little bit is credit risk. The second one is interest rate risk. So let's say you buy your bond at 4%, and then all of a sudden interest rates jump up to 5%. All bonds of that caliber are now paying 5%. You decide, I want to sell this 4% bond. Who wants to buy your bond paying 4%? if they can go out and buy the same one at 5%?
Yeah.
Well, nobody, right? And so what do? You have to discount it, right? So maybe we're selling it for $900 instead of the $1,000 that we bought it for in order to make that yield go up so that it's effectively yielding the same as the market. But what's cool about bonds is the inverse is also true. And so let's say interest rates, we buy it at 4%. Interest rates drop to 3%. Well, who wants our bond paying 4% when the rest of the market's paying 3%? Everybody, yep. Right? And so now we're selling our bond for $1,100 or give or take, right? Instead of $1,000. And so bonds do have a couple market movers, right? That'll kind of push them one way or the other, but they tend to be a lot more stable than like a stock or an equity class.
Okay.
Yeah, just a point of clarification really quick. When we're talking about yield, we're talking about interest rates. Right. Yeah. And so a lot of times as advisors, we'll talk about yield interchangeable with interest rates. This bond is yielding 4%, or this bond is yielding 6%, or this money market is yielding 3.6%. And that's just what, another term for interest rate. This money market has an interest rate of 3.6% today.
Okay.
And so just so that you're not getting confused.
Yeah, I mean, it's not coming to a stop at a stop sign, a yield sign. It is. It's an interest. Yeah, like it has the same word, different meaning.
Yeah.
So, okay. Very good. Now, when we're talking just basic financial portfolio stuff, you got your stocks, bonds, but you have cash. What's the importance of having cash in your portfolio, Rex?
Yeah, cash is king, right? Cash is important.
I've heard that somewhere.
Have you heard that somewhere?
I think
the very first podcast.
I don't know about our very first, but probably our second. It was one of our early podcasts. It was one of our early podcasts. I think our first one was on how to select a financial advisor.
Oh, you might be right.
It was our very first one. And so I know.
He remembers.
Yeah. So I think as far as cash is concerned, is cash, you're not going to get price volatility. A dollar is a dollar. It's you're not going to most of the time. I guess there's one time when there was a question if a dollar was a dollar during the financial crisis.
Well, what if your $1 coin from years ago is worth more than $1 now or something?
Yeah, and that'd be a collectible coin, right? Something like that. And so that certainly is going to be in a different caliber if you have a collectible coin. But the nice thing about the role cash plays is, one, it adds stability to the portfolio because it's not going to go up and down in price. The interest rate will change, but the price won't change. And then on top of that, it provides, because we have that stability, if we get into a situation where all of a sudden interest rates have gone up and the stock market has gone down at the same time. And so, I can think of 2022 when that happened, right? We had interest rates rise very severely, something like 12 times in 2022.
To combat inflation. And all of a sudden the stock market took a big dip during 2022. Because it was worried about inflation.
Because again, it was worried about inflation. And so we didn't want to, and so your bonds were down and your stocks were down at the same point in time. And so we wanted to make sure we had cash to handle those distributions, so we weren't having to sell those things at discounts at a lower rate.
And that was a little unique, right? Because typically when the market is in trouble, the Federal Reserve is trying to lower interest rates to kind of stimulate the economy on. Well, as they lower interest rates, what does that do to our bond portfolio? It jumps up the value, typically, right? In this case, though, they were raising interest rates, to try and combat inflation, and then the markets were worried about inflation. They were worried about rising rates. And so then the market, equities or stocks had a hard year as well. And so it was kind of the perfect storm in a lot of ways, where both bonds and stocks, neither of them did very well.
I think people get confused on the Fed an awful lot, right? The Fed has a dual mandate, right? One is to work on inflation, and one is to work on employment.
Yep. Would the argument be it needs one mandate, not a dual mandate?
I don't know. No, I think a dual mandate's good. I think it's worked out really well over time. And so, but I think it creates, the fact that they're going to raise or lower interest rates to impact inflation or to spur on the economy by, trying to get people to hire more employees to try and impact the employment numbers. And as opposed to, some people think that the Fed is there to drive the stock market, and the Fed is not there to drive the stock market. Because if they were doing that, they would keep rates low a lot and to heck with inflation, all right? Let inflation run rapid and just let the stock market run. And if that happens, you may end up with, record depression levels of unemployment, which again would spur into, a lot of other issues such as a Great Depression and things along those lines. So I think a dual mandate's fantastic.
Rex, did you want to talk about commodities? Because if so, here's your time.
Is this my
If not, forever hold your peace.
Oh, yes.
Wow.
Now's the time.
I only get a short window.
I didn't say
Put on
short,
the
just
spot.
now is your time.
Now's my time to talk about commodities. So, I mean, commodities, you're talking like gold and silver and things like that.
Oh, I thought you were going to go like pinto beans and
We could go
real
pork bellies.
Pork bellies. That's always the funniest one.
Pork
to me.
bellies.
Why pork bellies?
I don't know.
Well, because they're used in a lot of food materials.
Is that it?
Hot dogs.
Hot dogs.
No, I'm just kidding.
Like, why pork bellies? Like, there's so much, but why is it always?
Why is it gotta always be? Yeah, who's my pork? Have you ever met a pork
I've
belly
never met
trader?
a pork belly trader.
I've met a pork belly.
You have.
You
not.
have?
I
Are you
have too. Yeah,
serious?
they trade on the Chicago Futures Exchange.
Oh,
yeah. Went to school with a guy that went into pork belly trading in
Really?
Chicago. Yeah.
That's
awesome.
insane.
Yeah.
That's awesome.
No, he is insane now, actually. Yeah.
This is not good. Oh, jeez. Okay.
So, yeah,
Okay, but
poor
what is
guy.
this? What are? Because I play. Our family play. It's one of our favorite
Pit?
games. Pit is
that's
fantastic.
A good game. That's a good game.
With wheat and
Barley?
and
Oats?
no pork bellies, but you do
Gold?
have gold. No, you don't have gold.
Wasn't there gold?
No, but you have a
I thought my
bull
version had
and a
gold.
bear,
Yeah.
and so if you go out with one, obviously you make money. You go out with the other, you lose money. And so, but you can learn this game at a really pretty young age, and have no idea what it means in the greater scheme of things. But it is essentially the market, Rex.
It is. It's essentially futures trading on commodities.
Yeah.
And so, for today's 30,000 foot discussion, right, we're going to bring it back to gold and silver and just traditional kind of commodity prices, which are, a subject to inflation, right? It's also subject to loss of purchasing power in the sense of gold and silver, because they don't generate earnings over time, and they don't generate a interest payment to you. There's no cash flow there. You just own what I refer to sometimes as a dead asset, meaning it's not going to grow on its own intrinsically. It's not going to kick out an income to you. And so you're subject purely to supply and demand on that commodity. And if more people are scared about the economy and they're worried about the U.S. government imploding or going under or something like that, or world events, then those commodities become more valuable, because people feel like, well, if the world ended, I could trade, this gold has some value to where I could trade it for a cow. I could trade it for some chickens. I could trade it for food, those kinds of things, because people still might like their jewelry, or it's used in metals. It's used in weaponry. It's used in different kinds of things. And so that's why they have that there.
Rex, do you have a commodity garage that no one should know about?
Halloween decorations.
Yes.
Yeah.
You
Halloween could be considered
a commodity.
Hot commodity.
Yeah.
No,
But to that point, I would argue, because people like that idea, right? Oh, in this like apocalyptic world, I can, I'll go down and I'll have my tangible gold and I can trade that for something. And my argument is that initially, who cares if you have a shiny piece of metal? You want food. Right? Like, you want food and other survival.
Yeah, eggs might be worth more than gold.
For sure. Absolutely. Right? Like, if you're really prepping for like an end of world scenario, it's not gold, it's food. Right? It's the things that people need to survive on. And then eventually, right, if we're playing the scenario out, once things stabilize, then gold, I think, would become valuable again very quickly. But at the end of the day, I think you got to go with stuff that actually has value.
Yeah, I think it's definitely an interesting argument, right? Because I think gold and silver and things like that are easier to purchase, right? Because you can pay $4,000 and buy an ounce of Troy gold or whatever the current price is, right? Or silver, you can pay $100 and get a little silver coin, and so that's fairly easy. It's much more difficult to maintain and sustain an entire coop of chickens for your eggs. Right. And so you've got to have land for it. You've got to be in a zoning for it. You have to buy the chickens. You have to feed the chickens.
You can buy food storage. You don't need to.
Right.
Yeah.
And so, and food storage lasts for a certain amount of time. So you got to cycle through that.
Sure, right.
And food storage is good for certain types of food. It's not good for other types of food.
Sure.
Right. And so, I think people view that as, okay, if I have some of this, then I might be able to trade that for somebody that sees a stabilization in the economy at some future event, which is what would give that gold a value.
And that is the key. Yeah. That's exactly it. They need to see that future stabilization of the society.
Yeah, in order to want to use your gold and trade that for some, for a meal. Yeah. So, but people ask, should commodities be part of our overall portfolio? And because commodities also can provide a non-correlated or a negatively correlated or low correlated return to the stock market. And what that means is when the stock market is down, commodities may be up, down, or flat. They're not related. They're not correlated to the returns of the stock market. And so it can add some stability to where if the stock market goes down sharply, a lot of times those commodities are up or maybe flat and may provide another asset that we can sell if we need cash flow at some point in the future. The problem is people own that and they don't want to sell it during the downtime because in their mind, that's exactly what they bought it for. Yeah. Was in case the world goes under, then why would I want to sell this now? Because I'm really going to need it 30 days from now. Right. So,
okay. So you've got your portfolio of stocks, bonds, and cash, and a flock of sheep and gaggle of goats or whatever you got going on. And now distribution comes. And so it kind of led up to this, Rex. So why build a portfolio if you can't access it? And when do you access it? And what are the basics of that? And some of the notes here, Brandon, that you've written down was like, using less volatile assets to fund the next 5 to 10 years, and then moving on from there, 10 plus years. So how does that work? How do we get to our funds, and what's the distributions look like?
Yeah, so this is like where the magic happens, in my opinion, right? And the magic in two ways, right? You're building an efficient portfolio that should be able to get you really solid, consistent returns over time, and you're also building a portfolio that you can trust to get through the downturns, right? And so what we're doing is we're building a financial plan, and we're saying, all right, over the next 5 to 10 years, what is your distribution rate need out of this portfolio, right? What are your retirement goals? When are you retiring? Maybe you're already in retirement. Over the next, based on your Social Security income, based on other, pension, based on your future needs, maybe a car purchase, maybe just ongoing monthly expenses, how much of this portfolio are we going to need to pull out, regardless of whether the markets are up and down? And so we project that out 5 to 10 years. Why that number? Well, because when you look at past recessions, most recessions don't last very long, right? Most are, 18 months, 2 years. But the really, really bad ones, like the 2008, the 2000 tech bubble, those are about a 5-year event, right? For the markets to recover. And so we recognize that, hey, there at any given time, we might not be able to really pull from the stock portfolio without recognizing significant loss for, a 5-year period. Therefore, we need to make sure we've got less volatile assets set aside that we can draw on to make our way through some of that downturn.
Mm-hmm. Yeah, I mean, when you're talking about, kind of a 5-year period for recession, and I know you said this, but it was kind of soft, so I'm just going to repeat it. But, a typical recession, like you said, might last 18 months, 6 months, maybe 2 years in an extreme situation as far as the actual recession. And so if you look from peak to bottom to recovery back to that peak, that's where that 5-year kind of period. And so if you look at the Great Recession of 2008, the market peaked around the beginning of 2008, right? January, February, March, right in that time period is where the market peaked. And then it crossed that peak again around 2011, 2012. And so it took kind of a 3 to 4 year period in that situation to go from peak to trough to peak and kind of cross that level again. If you look at 99, right, it went through a downturn of 2000, 2001, 2002. It was a 40% drop over a 3-year period.
Right, long time.
Basically, and that was a longer drop. The actual economic recession was very short during that time period, but the market continued to drop because we had 9/11, we had some extenuating circumstances, and then it had actually recovered. It hit the bottom in 2002, and it had actually recovered by 2004. And so again, it's kind of in that 3 to 5 year time frame.
Well, I'm glad you said that, because when times are good, it feels like times are never going to be bad. And when times are bad, it feels like times are never going to be good. So
right. Yeah, never a truer statement, right?
Yeah.
Yeah. Yeah. And when you're in the throes of it, especially if you're taking distributions, that's stressful because, the market's down 40%. And so your entire portfolio might only be down 10 or 20, but the stock portion of your portfolio might be down 40, right? And we don't want to be in a position where we're having to sell the stock portion of the portfolio during that time period. And so we want to make sure that we can ride through that, which is why we have the other asset classes, whether it's bonds or cash, and that we've planned for distribution. So we might have bonds maturing every year for the next 3 to 5 years, so that money is coming due and we're getting that principal back in order to fund our spending additions in addition to our pension, our Social Security, things like that. And sometimes we run into situations where people over their lifetime need to take more risk than they're comfortable taking, right? And so, we may need to have 70% exposed to the market in order to shoot for those higher rates of return to sustain their standard of living. And they're highly uncomfortable with that, knowing that when the market's down 40%, they may be down 30%. And they're afraid that they will stress sell at the bottom, which we see people do a lot. And so instead of doing that, sometimes we'll see people utilize products like annuities and things like that to where it provides a lower long-term rate of return because the fees are typically higher than the overall market, but it provides a little bit more stability on the distributions if we needed to turn on an additional distribution stream during those time periods. And I know that's a topic that we don't talk about a lot because we're not huge fans of annuities in general because of that exact reason, that typically you get a lower rate of return over time and typically the fees are higher, and then they're also not, there's a lot of complexities to them, whether we're dealing with distribution rates or surrender charges or different kind of access issues that we can run into when we're dealing with that. But for those types of individuals, sometimes those are okay products in very limited situations. The problem is that too many people sell them as a cure-all, as something that's going to fix everything. And the problem is sometimes it creates more problems than it helps.
Yeah, you're likely going to end up with net a lot less money when you use an annuity. But sometimes people are okay with that if that means that you're going to, have a little bit more stable ride, right? But you also have to recognize too that those promises, right, those benefits, those payments that they promise to pay out, that's only based on the insurance company, right? The insurance company's ability to stay solvent and be able to pay money out, right? That's not a guarantee from the Almighty, right? Like that's a guarantee from an insurance company. And so you gotta weigh all that in. I think as you look at this high level and you look at building this out, it's when times get really, really bad, like we saw into 2020 and when we saw in 2022 where there's a lot of uncertainty, markets have dropped a lot. That's a very comfortable conversation we can have with a client to say, hey, look, based on where we're at today, as long as this gets resolved in 9 years, we're good, right? We've got 9 years worth, depending on the client, right? Anywhere between 5, 9, 10, kind of depending on where they want to be. But we've got 9 years for this to get figured out before we would really even need to start digging into the stock side of things. And even then, right, we've got our stock's so well diversified that we can pick on internationals or large cap or mid cap or value. And so there's a lot of opportunities there, but usually that helps people feel very comfortable and confident when going through, unknown situations.
Love it. Next up, we're going to learn about the rule of 4%. But before we get there, Brandon, we need some more numbers. And Rex, I was telling you before the podcast that I had some Red Bulls a couple weeks ago. Yeah. I haven't had a Red Bull in years. And then And I actually eat pretty healthy. Like I usually fast about 16 hours and I eat like whole food at home. Like I eat pretty healthy most of the time these days. But oh my gosh, I was emceeing a competition, a ski competition on a mountain. And I was like, oh my gosh, I don't know what to take for lunch. I don't have any food. And so I raided the kids' food jar, which was s'mores Pop-Tarts, right, for breakfast. And then they handed me Red Bulls on the mountain. And then also the first snack they had were these giant cinnamon rolls. And so I had like s'mores Pop-Tarts, Red Bull, and cinnamon rolls. And I'm like, day one, I was on fire. Like I was like, this is the greatest diet ever. And then by day 3, I'm like, I don't feel so good. Like I need some like actual food or whatever.
You did that 3 days in a row? 4
days in a row. Yeah. I mean, I had food when I got home at night. It was like normal actual food, but on the mountain, I'm like, this is the routine. Pop-Tarts, Red Bull, and cinnamon rolls. Oh, gosh. And I could see how like maybe high school kids do that stuff, but it really does wreck you. It is not a good diet, dude.
That is brutal.
Anyway, this portion is not brought to you by S'mores Pop-Tarts. It's just brought to you by S'mores, Brandon. S'more numbers.
Speaking of energy, so the U.S. Strategic Petroleum Reserves, we've heard of those, right? And where essentially we're storing a bunch of oil and sometimes presidents will say, hey, we're going to dump oil into the economy or we're going to refill our strategic reserves. Do you know where and what those reserves are?
No, but also now that you may bring it up, I want to be able to log in and look at it in real time.
Yeah, like kind of like a gas tank.
Yeah.
I want it to be audited. I want someone to go and make sure it's really there.
Yeah.
Where's our YouTubers?
Where's my dipstick? They can go and tell me how full it is, right? I can dip it in there.
So these reserves are in Texas and Louisiana.
Okay.
They are in there's 60 different salt caverns that are, and so I didn't know, I had no idea what this was, so I looked it up. Turns out there are huge deposits of salt underneath, and essentially what's happening is this salt, as the pressure from the earth is like pushing up or pushing down on the salt is lighter, and these salt pillars form where salt underneath, and we're talking, I mean, half mile underneath the surface, right? We've got these massive pillars of salt that have formed and have grown. And so what we're doing, and this is wild, we are drilling down to these salt things that are about a little over 2,200 feet underground for the top of this salt pillar. Mm-hmm. This salt pillar is 200 on average. They're about 200 feet wide, and they are about 2,500 feet tall. Right, I mean that's Washington Monument's like 555 feet.
So that's half a mile.
Yeah, tall, right?
Basically.
200 feet wide, but it's salt. And so what do? We dump a bunch of fresh water into this big pillar of underground salt, and then we pump the salt water out into the ocean, and we end up with this big salt cave, and we're dumping petroleum into these salt caves as our reserves.
So they're ex-salt caves.
Right. They were salt, and we essentially removed the salt via adding water.
How did we find these things is what I want to know. Some dude was like, I feel like there's salt about 200 feet below my feet right now.
Yes, because they take core samples, right, to drill for oil.
Yeah, I'm like, what?
This is salty.
This isn't dirt.
Oh.
Well, I'm sure. So we take core samples and stuff to try and figure out where oil is.
That's true.
Right? And they especially in that area, right, you're drilling down, you're like, this is just a core of salt, and so
wild.
Anyway,
interesting.
But they store it there.
But that's where they store it, and I used to have this down how much but I mean, tremendous amounts of oil can be stored in those. Mm-hmm. But that's how we're storing it. Is we're creating these salt caverns.
Because I'm imagining a giant cement,
a big tank. Yeah, me too,
or something.
Yeah.
But the earth literally holds it in, I guess.
We're just pouring. And I think, and I could be wrong here, but I think it's just raw, like oil in its rawest form, right? And so it's not refined yet. And so it's a lot more stable, and you just pump it in, pump it out. But
why pump it out of the earth in the first place would be my question. Why spend all the money to pump it out, to pump it back into a reserve? We already know from the core samples where the oil is.
Well, it's got to be faster to get it out.
It's faster to pump it out. And oil, you can't just turn oil wells on and off like a spigot.
Not like a light switch.
No, you damage oil wells by even turning them off, I've heard.
Huh.
So I think it is. I think it is to just have a bunch of just raw petroleum and we can just pump it out fast, right? And then refine it. But anyway,
interesting.
Thought that was really interesting.
Yeah.
Oh, especially since we're at war with Iran right now.
Right.
Oil prices have been extremely volatile, jumping up to over $100 per barrel and back down to 85 and back up and forward.
Yeah. So these big salt caverns can hold up to 714 million barrels of oil.
That's insane.
714 million barrels.
Yeah.
That's so much oil.
We don't have that much in it right now. We've actually drained quite a bit.
Yeah.
But yeah. Anyway.
Well, when we find the coaxium and we can
Someone's watched too many sci-fi movies.
So we need to switch to that as soon as possible. As soon as possible, we'll get to the coaxium. All right, so rounding out sort of this high level overview of investing and what y'all sort of teach the concepts here to live by. There is a 4% rule. Brandon, what is this?
Yeah, so the rule of 4% is an age-old, it's been around for a long time. And if you want to see a bunch of like nerdy people fight each other, just type in, does the rule of 4% apply?
Yeah, do you bring this up in meetings just to get a rise out of people? Like,
well, not to get a rise, but we bring it up in meetings so that we educate them and talk about it because it's definitely a rule of thumb that's out there.
Sorry, not meetings with clients, meetings with amongst yourselves, other financial professionals.
Oh yeah, that's like throwing down the gauntlet.
Is that throwing down okay.
You believe in the 4% rule because you're dumb.
It's interesting. So you get people arguing literally both sides of it, and in my opinion, it's a clickbait thing, right? The 4% rule of 4%'s been around for so long, and I think people love to write an article like the new 4% is 3.5%, or
4.1.
Right, and it's just like, okay, guys, but at the end of the day, what is the rule of 4%? The rule of 4% is that you can pull money out of, because everyone wants to know, I've got this much in my portfolio, how much can I pull out over a 30-year retirement and have a high probability of having enough or more than enough for the duration of that retirement?
Okay.
And the risk is...
And you run it down?
Right. Well, it depends, right? It's a sequence of returns risk that we're worried about. And what is sequence of return risk? It's the risk that you go into retirement and you immediately see a giant, long-lasting recession. And that's kind of one of the worst case scenarios, because then all of a sudden we got to get through it. And it's kind of fun to look at. There's plenty of charts that show the same person with the same amount of savings retiring at the same age, and the only difference is, one retired in 2020 and one retired in 2025, right? And the difference in their portfolio over time can be dramatic based on when recessions hit. And of course we can't predict those, right? And so the question is, well, what's a good sustainable rate of return, especially in those initial years of retirement, to make sure that we have a very high probability of getting through retirement and having plenty of money.
And so 4% is the withdrawal amount.
Right. So if you have
portfolio.
Right. So if you have a portfolio with 1.5 million in it, right, then we could take 4% of that, or $60,000 each year, increase that distribution for inflation each year, and have that high probability of success. Now, that's not your total spend, right? Because you might have 1.5 million, but you also have Social Security and other things, other factors. But that 4% is kind of the target of what we're trying to distribute.
How much does... Oh, Rex, you want to say something?
Well, I was just going to say, we go into this a little bit on our rules of thumb, right? But and again, it is just a rule of thumb, because that can be impacted if you're 75 and your lifespan's, expected lifespan's 15 years, you can probably pull out more than 4% at that stage.
Or I've got clients who are waiting to pull Social Security, right? And so we might be pulling 7% for like 2 years, right? And we're doing that because we want to grow the Social Security. But then once we pull Social Security, then our distribution rate falls down to like 3.5 or something, right? And so there are definitely exceptions.
So you can play with this a little bit. Okay. Yeah. So how much, just on a standard scenario, does 1% in either direction make a difference, Ed?
Enormous difference, right? Because if you go to a 5% distribution rate, your probability of running out of funds during your lifetime increases substantially.
Really?
It drops by about 20%.
Yeah. And so instead of running out of money maybe when you're 100, you might run out of money when you're 80.
Because just not knowing anything, right? You're like, what's 5%? 5% versus 4%, like it's 1%, big deal.
It's a big deal.
It's a big deal. Okay.
Yeah, 1% makes an enormous difference.
Okay.
And same with if you drop it down to 3%, then your portfolio should continue to expand at a fairly strong rate over your lifetime.
And this is sustained over time, right? Because you might say, well, man, if I take 5% this year, is it really going to make that much difference? And the answer is it might not for this year, right? Especially where, especially lately, the last several years, right, our rates of return have been so much higher than we'd expect, right? Not by the magnitude of 1%, but by 3, 4, 5, 6% more than we would have expected, right? And so can you take an extra % or 2? Yeah, probably, right? And be fine. But it's that sustained higher distribution rate, especially that sustained higher distribution rate through all market cycles. And we talk about that with clients, right? If we can be a little bit more flexible and maybe take a little bit more while markets are good and then take a little bit less while markets are down, then sometimes we can play with that rate a little bit more. But that can be hard to do, right? It's hard to adjust spending. And so you got to make sure that really is discretionary spending that can change.
Okay, very good. Well, the last point was annuities, but Rex, you kind of touched on those. Anything else you want to add about using annuities as part of your overall portfolio on this high level?
No, I think at some point we should do a deep dive on annuities and talk about the different kinds, whether it's fixed or variable, things like that. But I think in essence on annuities is you need to understand that annuities, any insurance product really is probably one of the most complex instruments that we deal with. It's more complex than stocks. It's more complex than bonds. It's more complex than cash. There's so many nuances that are unique to your individual insurance company and in particular that individual annuity contract that you need to make sure that you're understanding that before you buy it. And unfortunately, a lot of times, as individuals, we really tend to focus on the positives of it, and that's what we want to hear. We want to hear, how's this going to help me? What's it going to do?
Tell me I'm pretty.
Right. Yeah. Right. How beautiful am I again?
Yep.
Tell me.
Yep.
Right. And that's what people tend to focus on annuities instead of looking at the entire pros and cons list and really focusing more on the cons to understand, okay, if things don't work perfectly, then how do I get my money back? What does this look like? How does this impact my overall net worth growth? How does this impact, the stability of the portfolio? All the different nuances that go into it. And I think that's it. But annuities in general aren't good or bad. They're just a product, right? And all the products out there, none of them inherently are just good or bad. They're just a product. But they certainly can be sold for good situations or they can be missold for bad situations. And that's where we tend to take more of an issue, is we see them too frequently sold in situations where they probably are not the best fit for what you're really trying to do. Okay.
And if you want to learn about options, I'll give you Rex's phone number.
Yeah. Puts, calls, butterflies, spreads. Let's talk.
Let's
just
go. Very good.
We don't do very much of that anymore, do we?
No, we don't.
Yeah.
Yeah. You're more, do I dare say basic?
Well, I don't know that we're basic.
Yeah, okay. We ain't basic. Very good. Well, that was sort of an overview, and so I appreciate that from two financial advisors who've been in the business for quite some time and have the accolades to prove it. So, Rex, thanks so much. Appreciate it. Yeah. This podcast. If you found value in this podcast, you can consider supporting us at buymeacoffee.com/Banyan Media. That's Banyan, Banyan Media, where you can give us a few bucks. Every dollar helps because we invest it with Rex Through the Pines, which is great. And then you can watch, if you're listening to this podcast, but you're like, what do they look like? Well, good news. We are on YouTube, and you can watch our wonderful, beautiful faces on YouTube at Through the Pines. You can even like our Facebook page at Pines Podcast, and we share shorts and reels and on our Instagram page at Pines_podcast. This has been Through the Pines, reminding you to use yesterday's dollars to finance tomorrow's dreams.